More banks on the verge of insolvency. The global financial system has been hit hard by the current banking crisis, with the failure of several prominent banks, including Silvergate, Signature, and Silicon Valley Bank, and more to come. Naturally, the fallout from these failures has prompted widespread fear and panic across the banking sector, with many questioning the industry's stability as a whole. And now, even after several massive bailouts totaling billions of dollars, First Republic might be the next domino to fall. Since the beginning of the year, massive withdrawals and diminishing reserves have decreased their stock prices by 95%. Furthermore, China's yuan gaining in popularity as an international currency and potentially challenging the US dollar's long-standing dominance, and the US economic slowdown due to decreasing GDP numbers has made matters much worse. Hello and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to leave a like, subscribe, and comment below if you enjoyed watching this video, and turn on the notification bell to keep posted. And now, without further ado, let's start. The most recent banking crisis is a developing disaster. All of this started around 2 months ago with the failure of Silvergate, Signature, and the prominent Silicon Valley Bank. Each of these businesses had a very specialized target market primarily focused on commercial banking for the tech industry, which meant that most of their deposits were beyond the FDIC insurance thresholds. Normally, this wouldn't be a big deal because bank failures aren't that common. However, in this case, as venture capital declined, more and more clients started to withdraw their deposits, forcing banks to start selling their assets at a loss, which alarmed more consumers that the bank might be having problems, which prompted more people to start withdrawing, and so on until they were eventually closed down and taken over by the FDIC. As you would imagine, this sparked fear across the whole sector, since if one bank fails, who's to say it won't happen again if everyone decides to take their money out? Since banks are only required to hold a small portion of customer deposits in reserve for withdrawal, it could be disastrous if everyone rushes to leave simultaneously. First Republic Bank received a cash injection from the Fed to stay afloat after losing $52 billion in market value. More fundamentally, they did resemble Silicon Valley Bank in many ways, leading most of their clientele to break away. First Republic Bank first made an effort to assuage their customers' fears by claiming that they have over $60 billion of unused borrowing capacity, in addition to a well-diversified deposit base. However, it soon became clear that the bank's problems were more with its lending than with its investments. As the Wall Street Journal noted, First Republic's assets exhibited an enormous gap between their fair market and balance sheet values. If First Republic needed to sell assets to raise cash quickly for any reason, the difference between its balance sheet value and its fair market value would be $26.9 billion. This would indicate that the First Republic issued and held on to enormous loans from wealthy clients at low interest rates, and that these loans are now worth substantially less. Banks won't just take your cash and hide it in a drawer. Instead, they invest it and lend it out to keep things going. And if everyone wanted to withdraw their money simultaneously, the bank would be forced to liquidate everything they own to raise enough funds, which would be extremely difficult without incurring a loss. So in order to keep the First Republic from going under, several larger banks came up with a $30 billion rescue package. This was done in addition to the Federal Reserve bailout, which enabled banks to obtain as much money as clients wanted to withdraw. That seemed to calm things down pretty well, but on April 24th, First Republic announced that deposits dropped by 40% in the first quarter, which was much worse than predicted. Additionally, they received a $30 billion cash injection from other banks, so if those deposits were not included, First Republic's deposits would have decreased by more than 50%. Their stock started to fall at the same time that rumors of a rescue plan started to spread. After announcing that the bank was evaluating strategic options to help transform its balance sheet, its advisors allegedly attempted to convince other banks that allowing First Republic to fail would be even more costly if it resulted in higher regulatory costs and fees. Furthermore, it has been speculated that the company might dilute its existing shareholders by issuing new shares, if doing so would enable it to attract additional capital. Due to this instability, American authorities were considering downgrading the whole bank, which would decrease its ability to borrow money from the Federal Reserve and harm its prospects of successfully making a turnaround. Furthermore, based on reports from sources, it appears that the government is no longer willing to step in and provide assistance. The government is allegedly still hoping that the First Republic would work out a solution to prevent the company from failing and taking some of its money with it, while the involved bankers are apparently still expecting a government takeover. In essence, this is turning into a game to see which comes first: a takeover by the government, an injection of funds from other banks, or bankruptcy. And right now, it's too soon to say what will happen. According to the Wall Street Journal, First Republic's actions today will likely impact future challenges and will serve as a template for what happens to other banks. Moreover, if larger banks allow them to fail, that results in higher assessments for all the other banks, which raises expenses. The last thing everyone wants to see is a prolonged banking crisis, so it's crucial to watch how this plays out. While we're on the subject of dollars, China has recently discovered a way of entirely avoiding them, as the yuan has recently surpassed the US as the country's most common cross-border currency. China has been gradually lowering its reliance on the US currency since 2010. Around that time, it is believed that the US launched its first round of stimulus efforts worth $600 billion, which led to a decline in the value of the dollar and put pressure on China to maintain the stability of its currency. This caused China to depend less and less on the US currency over time, along with tariffs, and it reached a breaking point in 2020 when it formed a financial alliance with Russia to completely abandon the dollar amid sanctions. In its simplest form, this is all referred to as de-dollarization, which means replacing the US dollar as the world's reserve currency or providing more competition to lessen the dollar's dominance. Depending on how you view the situation, this may or may not be a cause for concern. On a global scale, not much has actually changed, and because just 4.5% of all transactions take place in the yuan, there is little cause for concern. Even though it may not mean much in the near future, it is a sign that the US dollar's hegemony is indeed declining. However, if inflation keeps declining or at least starts to level off, we might be able to avoid the alleged hard landing that everyone has been fearing for almost a year. Last but not least, there is still no resolution to the debt ceiling issue. There is a maximum amount of money that the United States may borrow. It was formerly estimated to be $31.4 trillion, but that figure was already reached in January. This indicates that the United States is due to run out of money and default as early as June unless Congress approves a bigger budget, which would be a nightmare for the whole nation. As a result, the House approved a bill raising the debt ceiling by an additional $1.5 trillion. However, that bill included a number of spending reductions, concessions, and other measures that would repeal most of the economic stimulus measures passed over the previous few years. As a result, the Senate is anticipated to reject the plan in its entirety and instead reaffirm that the budget should be raised while keeping the current expenditure programs in place. Currently, the United States is set to default in about 60 days. No one thinks this will happen, but politics can sometimes be incredibly bizarre. Hi! We hope that watching this video was interesting and that you learned something valuable. If you enjoyed it, please hit the notification button, like, subscribe, and watch more of our videos. Also, don't forget to share your comments in the comment section below. This is Finance Sense, helping you stay current on all the most recent changes in the financial markets and economy. Stay safe and look out for the next video.